As much doom and gloom as there out in the market, always remember what history teaches us, that humanity keeps moving forward and eventually everything works itself out. Hey guys, Omar Khan here with Theta Trading, and I hope you guys like the videos that we're producing. If you do, please hit that like button, hit the subscribe button. We're trying to get it to 1,000 subscribers and really get this message out there. This is what strategy that changed my life. If you want to know more about the Theta strategy, look at some of our previous videos. We really could use your help getting the word out there and promoting the channel. All right, so today's topic is simple. Will the stock market recover in the next year? That is the question on everyone's minds. Is it going to recover? When's it going to recover? Well, we know one thing. History teaches that the stock market has always gone to an all-time high. Now, sometimes it takes longer, sometimes it's quicker, but it's always gone to an all-time high. I want you to remember that. As much doom and gloom as there out there, as much fear as there is out there, always remember what history teaches us. It's always gone to an all-time high. Why? Because life keeps getting better. Humanity progresses. Innovation keeps happening. And humanity keeps moving forward. So, let's first take a look at how the first half of the year went. So let's take a look at this one. First, we have had a dismal start to the year, okay? So we've had the worst start of the year in the S&P since 1970. That's 52 years. You can see we peaked around 4,800 on the S&P, and now we're around 3,700. Substantial decline. Everything has gotten hit hard except for oil and gas. But oil and gas is now starting to take a beating as well. All right, so we've had the first half of the year being the worst first half of the year. And the reason is because of inflation, interest rates. That's the thing on everyone's mind. And now we're starting to see a real effect on the housing market as well. So what the Federal Reserve has to do in order to combat inflation is they have to raise rates. So what we're looking for is less inflation. You can see inflation everywhere, at the pumps, at the grocery stores, and everywhere else. Now, so we know the first half of the year was horrible. All right, so let's take a look at the second chart here. U.S. stocks headed for the worst start of the year since 1970. This is the first half performance of the S&P 500. And you can notice something a bit weird here. You have heightened levels of volatility. Volatility just means crappy markets. That's what it really means. It means a market that's not doing so well. That's exactly what that means. All right, so you can see here it says EY and MT. So you got your election years and you got your midterms. Okay. So this year is a midterm year. We can see midterm years, they can get pretty hairy. This one doesn't seem to be a whole lot different. In fact, it's probably as bad as it's been in a long time. So, midterm year, worst half of the year to start since 1970. And again, I really want to point out here, this goes back to 1967. Look at all the election years, look at the midterm years, and this is the United States midterm and election year cycle, of course. And you can see a distinct difference. There's a lot more downside pressure in election years and midterm years. And this being a midterm year, no exception. Okay, now let's take a look at this. Again here, first half of the year. So we're going to get the bad news out of the way first, all right? Bad news out of the way first. All right, second half of 2021, we had a nice, slow grind up. Everything was sunshine and rainbows. But as Warren Buffett says, when others are fearful, be greedy. And when others are greedy, be fearful. So the second half of last year, people were greedy. Markets had risen to an all-time high, and there was no reason to doubt that they wouldn't keep because the Fed kept saying inflation is transitory. It's not going to be persistent. We don't need to raise rates. That's what the Federal Reserve kept saying. Now, we can see again here, first half of 2022, the Fed has shifted from saying inflation is transitory to saying, nope, it's real. We got a problem on our hands, and we have to raise interest rates aggressively. And that is what they're doing. They're raising interest rates aggressively. Why? Because they want to bring inflation down. And how they do that is raising rates again, right? And the idea is to slow down consumption, slow down borrowing, slow down all these things, and putting less pressure on prices, okay? That is what they're trying to do. They're trying to orchestrate something called a soft landing. All right, so now, worst half since 1970, horrible. Now let's take a look at this next chart. We can look at the intra-year declines versus the calendar year returns. So as bad as it may seem at one point, oftentimes when the market does really bad, it doesn't necessarily finish off on the same point. Now this goes back to 1980. You can see the data here. A good example here is 1987. We were down 34% at one point in the year, intra-year, climbed all the way back up to 2%. Now, the two areas to really focus on is the tech crash in the early 2000s, so 2000, 2001, 2002. Those were really horrible years, but that is mainly due to really inflated values on technology stocks. That's when I first started investing in the late 90s, early 2000s, and I remember if you had a .com name, you were getting astronomical valuations. And what the market realized and went into a recession is realized, oh, these companies don't actually make any money. They might not ever make any money. And the stock market, especially on the NASDAQ, sold off precipitously. All right, now let's flash forward to the credit crisis, 2008, 2009. That was the unraveling of the U.S. housing market and the following credit crisis that ensued. You can see here at one point in 2008, and this was probably the worst one I've been through in my lifetime anyways. 2008, 2009, it felt like the world was coming to an end. You can see in 2008, markets were down 49%, but it only finished down 38%. The following year, it was down almost 20. It was down 28% at one point, but it finished the year positive at 23. And we've had a pretty good run since then. COVID is another example. 2020, you can see it was down minus 34 at one point, but yet finished the year off at a positive 16. This year, we were all the way down to a negative 24. Now we're at a negative 21. Despite the average intra-year drops of 14%, annual returns were positive 32 out of 42 years. Because we know the stock market goes up over time. It kind of does one of these things, right? And you have to be able to absorb the downturns. In fact, that is when you should be most opportunistic if you have capital. Because now, let's take a look at the next chart. What does history teach us? And I apologize, again, guys, this chart is a little bit blurry. This is when you have 20% plus 2 quarters drops for the S&P post-World War II, okay? So we can see in 1962, 1970, 74, 02, 08, 09. We've had some pretty substantial drops. Now, this is 2 plus quarters, okay? Now we're going through it again. But again, what does history teach us? We can see what the average return was 3 months following, 8.51%. Pretty good. Next half of the year, 21.47 on average. And over the next 12 months, 31.36. Now, nobody in this world knows what's going to happen in the future. But what we can say with certainty is what history has taught us. History has taught us that every single time the market has declined, it has been a fantastic buying opportunity. The problem is you just don't know where the bottom is. That's why a lot of people prefer to dollar cost average. That's why I like our strategy so much. We get paid a lot of money simply to agree to buy stocks. Worst case scenario, we own those stocks. We can wait for the eventual rebound that we know history teaches us has always happened. Right? So this chart is something that should give you a lot of comfort. When you see all the negativity in the media, all the naysayers saying the market's going to do this and that, and the other, the world's coming into it, remember what history teaches you. History teaches you none of that's true. Humanity keeps moving forward and the markets have always gone to an all-time high. Now, let's get into the second part of this. Inflation is what is causing this issue, okay? This is the problem. So a lot of money was printed during COVID in order to get us through that really rough patch, okay? That caused all kinds of items to increase in price, mainly commodities. Oil really high, copper, diesel prices, all that really high. But we can see, and I hope you can see it at the pumps too, and see it maybe in housing prices, falling commodity prices raise hopes that inflation has peaked. Okay, we can see oil is coming down, wheat is coming down. Oil went as high as $120 a barrel. Now I'm doing this video as of July the 5th, 2022. Oil had a $10 drop today and West Texas Intermediate finished below $100 a barrel. Now that is eventually going to translate at the pump. People are going to start paying less. That means the cost of transporting groceries, cars, all the goods that we require for society, those are all going to cost less money to transport. Now that is exactly what the central banks are trying to do. They're trying to really lower inflation by raising interest rates. Now, this is happening. You're starting to see demand destruction. People are not driving as much. People are not buying as much stuff. They're more careful of what they're eating. They're not eating out as much. They're not going to the movies as much. This is exactly what they wanted. Lowering demand, lowering prices, therefore not having to increase interest rates as much as originally anticipated, right? So let's take a look at a closer chart here of what prices have gone down, how much they are down as of their July 4th peaks. Now, this is as of July 4th, excuse me, how much they are off of their record peaks. We can see diesel's down, gasoline, soybeans, copper, corn, crude oil, wheat, cotton, lumber, natural gas, all off substantially from their all-time highs. Now, this really hasn't translated to the data yet, but it will at some point in time. It just means there's not as much demand and supply imbalances, therefore prices are coming down. The Federal Reserve is going to say, oh, wait a second, this is exactly what we wanted. We wanted to slow the economy down, therefore controlling inflation. We're doing it by increasing interest rates. But now that we're starting to see data like this, maybe inflation has peaked. Maybe they don't need to raise interest rates as much as they did before. Now, this is what the markets are really looking for. The markets still have a lot of uncertainty around it. And we're starting to see this in housing prices now too. Because interest rates have gone up substantially, I'm sure you're seeing in your area, I live in Toronto, Canada, and I'm starting to see housing prices fall off substantially. I know you're starting to see in the United States, and we still have a lot of rent pressure, but these items are all intertwined, okay? So, just to conclude this video, guys, there is good news on the horizon. The good news, like I said, the markets have always gone to an all-time high, but the data tells us inflation may have peaked, and that is what the markets are looking for. Commodity prices are going down, oil and gas prices are going down, people are not spending as much, therefore the central banks may be saying soon, hey, we've done our job. We don't need to raise interest rates anywhere near as much as we originally thought, and that was part of the game to begin with. So, guys, I hope you guys enjoyed this video, and I want you to always remember, as much doom and gloom as there out in the market, always remember what history teaches us. History teaches us that humanity keeps moving forward, and eventually everything works itself out. Now, nobody knows how long it'll take, but we always know that it has come to an end eventually. Omar Khan, guys, here with Theta Trading. I hope you guys enjoyed this video. Please hit that like button. Tell us if you'd like to see what videos you'd like to see in the future. I'm happy to produce these videos. I want to share my knowledge. This is what gave me my financial freedom, and I want to help as many people as possible achieve their dream because it's a great spot to be in. Until next time, we'll talk to you soon. Take care.